Ladies and gentlemen, good afternoon. Welcome to UOB Global Markets webinar update. This time around, of course, I think everybody is very anxious and very worried about the latest development since Liberation Day just about a week ago. Financial markets, for the lack of a better word, are still in turmoil. Today, we still have heavy sell-off in ASEAN regional markets, particularly in Indonesia. Rupiah has fallen to a new record low. And of course, the same can be said for other key risk assets across the world. Today, we have with us key members of the research team to try to decipher for us the developments over the past week. So with us first, we have Mr. Alvin Liu, our senior economist. He will talk about update about the developments in the U.S. economy, as well as what to expect next for the U.S. Federal Reserve. Then we have Mr. Suan Teck Kin, our very own head of research for UOB. Teck Kin, as you know, is an expert on China. So Teck Kin will update on what we think is the outlook next for China's economy, given that China is now dealt one of the heaviest of the reciprocal tariffs from the US, and by extension, what to expect next for key economies across ASEAN as well. Peter, I think many of you are familiar, is our senior FX strategist. Peter will then follow up with an update of the currency landscape, what to expect for the US dollar and regional currencies. And finally, I'll round out with a quick update on key commodities as well, given that the reciprocal tariffs will affect regional demand for commodities. So without further ado, Alvin, please take it away. Thank you.
Hey, good afternoon, everyone. Thank you for joining us for this webinar. And I think the key thing is definitely one more day. This is 9th of April for tomorrow. Then we have the reciprocal tariffs coming in. So like what Khun Hao mentioned on just about a week ago, Liberation Day, by the announcements on tariffs, right, by President Trump was much more significant and broad-based than what markets and even us were expecting. So basically, the US tariff rate has now been brought to rates not seen in close to 100 years, definitely more than 20%. Effective average rate is now above 20%. And we know that this may not be yet the end of the series of announcements. So this is a selected numbers of economies that we picked out that has the tariffs, reciprocal tariffs being imposed on. Of course, we know that Singapore is on the lower end of things at the basic rate of the 10%, but some of the countries, especially in Asia, are the recipient of a significantly higher reciprocal tariffs. And of course, this itself, right, has materially changed our view on the trade scenarios. If you've been following our quarterly reports, not too long ago, we had a scenario where we did put a pessimistic case on the trade scenario. And if you look at this right now, we are seeing now some of the variables or the conditions that we have put forth for the pessimistic scenario. This has come true, and that's why we have seen a shift in our views in terms of the outlook itself. And in terms of the US, we have significantly downgraded growth, and we also see the inflation, on the other hand, also expected to spike higher. And on the other hand of recession risk itself, it definitely have moved higher. It's based on this, but we are not calling out for outright recession yet, but the risk is definitely higher and also dependent on what is going to be announced in a not so distant future. And if you recall, like the news overnight, of course, is the Trump's threat to further threat of in escalating the tariffs on China should they not rescind on their reciprocal tit for tat tariff on US imports, right, by the same amount of 34%. So that is a development that we are still closely watching. So if you look at the tracker itself that we have put on the measures that have been announced so far, so if you look at where we are according to a red line, definitely this would seem that the next important event is tomorrow, where the reciprocal tariffs will come into effect. Of course, over the weekend, we already have the 10% baseline tariff on all the imports going into US. And on this slide itself, you also see that subsequently there is still other areas or group specific products that will be targeted. That will be included semiconductor chips, pharmaceuticals are the key things that Singapore would probably look out for. And then there are the important commodities that we have listed here as well that is on the radar itself. And finally, even towards the end of the year, we also be looking at whether there will be tariffs on that digital services. So these are the key changes that we have for the US itself. Definitely, we are lowering the growth outlook for the US, given the material impact likely from the range of tariffs that has been announced and will be coming into effect quickly. Of course, there is chances that some of them being reduced after negotiations and some of them may be reversed. But for now, I think the outlook is definitely more on the challenging side, and definitely the tariffs on the tariffs itself, right? The uncertainty has definitely increased. In terms of the number of Fed rate cuts, we have raised it to 25 basis rate cuts for each of the quarter for the remainder of this year. And if you look at market expectations now, that has increased to, I think, more than that. But again, that is also again a point that for us to be dependent on how the tariff developments go forward. And tomorrow might be a very crucial day. So looking at this, we see that the Fed rate cuts coming in on 3, and I think for now this is I think quite a reasonable expectations, subject to again what happens overnight on the Chinese response and Trump's administration's taking effect of the reciprocal tariffs itself. And with that, I come to the end of my segment, and I'll hand over the time to Teck In for the outlook for Asia, especially China and ASEAN. Thank you.
Thank you, Alvin. All right, if we look at the China, look at the Asia situation, this tariff is actually quite harsh. And after this Liberation Day, particularly for Asia, the rates are particularly harsh. Alvin already shown you in the table before that. And that is, I think, quite detrimental, especially for those countries that are highly exposed to the US market. For example, in this case here, you can, in this case here, on the right-hand side, we look at the percentage of exports that are sent to the US, right? So those are highlighted ones are at least 15% share of their exports, right? 15. So there are plenty of these countries that are highly exposed to the US. As a result, you have a high rate that's applied to these exports, right? To these goods sent to the US. These countries down here will be particularly vulnerable to order cancellations and also I think these are declines in terms of consumer demand from the US. Right, for China, surprisingly, it just missed the cut at below 15% share of its exports. But it does not mean that China will escape, not being affected, because we are talking about the supply chain as a result, right? As a result of all these years of international trade and globalization, like about 14, although it's a less than 15% share for China's case, many of these products are actually sold to the ASEAN. And then in turn, you see these ASEAN countries exporting a large amount. In this case here, like Thailand is 21%, and others, for example, Vietnam is close to about 34%, right? 30%, 34%, depending on how you count the figures. All right, so further, so one thing that we think about how these tariffs will affect the countries and also companies operating is exposure to the US. The other one, what are the sectors at risk, right? So here I have this page and the next page will give you some idea what are the sectors that countries in a way specialize in. For example, in Singapore's case here on the left-hand side, about half of the exports are actually in pharmaceutical form. That means those companies operating in this sector or the supply chain around this sector will be highly vulnerable to, for example, if there is a tariff on pharma sector, that what potentially that could happen to the pharma or biomedical sector. I think Alvin alluded that earlier with the table on the tariff tracker. Right, for Malaysia, Malaysia's the typical case of those E&E or electronic and electrical products, and these are reflected in on the page here on the 85 and 84 code. So these are HS code 84, 85, meaning the harmonized system. Look at them as chapters on different products, right? So chapter 85, chapter 84. So all these products collectively is called E&E. And a number of ASEAN countries, later I'll show, you'll be able to see a number of these countries are quite specialized in the 85 and 84, right? So here we have, for example, Malaysia, roughly about half or more than half in the 85, 84, and then plus other products, for example, rubber. And Thailand as well, take a look at Thailand. Again, about, I think more than half is in the 85, 84. And what are these 85, 84? Those, for example, appliances. It could be electrical appliances, household appliances, and also in the electronic side, it could be those high-tech products such as MacBooks are built in Malaysia, and then you have maybe PlayStations assembled in Malaysia and sell to the US. So all these are under the 85 and 84. And then for Thailand itself, there's a rubber sector here, for example, tires, car tires. So that one is another item. So these are the exports to the US, right? Indonesia, less in terms of absolute amount is less, but nonetheless, it's also in the 85 and also some of these shoes, apparel industries. If you look at Vietnam itself, 130 plus billion exported to the US. Again, you can see a large part of it is in 85, 84, plus other furniture and footwear, shoes and whatnot, right? So that is where the many of these products end up in the US and now all at risk of the high tariff rate being imposed. Now here for China, China again, the 85, 84, very common, and plus other things like, for example, toys and plastic or whatnot. The list is so much longer because of the China's ability to produce. But again, I think the idea here is that all these sectors are all subject to the risk of subject to higher tariff right now. Now, India, just to give you an idea, also in the 85 sector, because of these supply chain shifts, right? Some of the iPhones are actually assembled in India, some laptops and computers and whatnot. So here it is, and then of course, India is a pharmaceutical, very much like Singapore. EU, just to give you an idea, and what are the products that for EU sell to the US. Now, so here are the sectors that are at risk or exposed to these are higher tariffs. Now, the other thing we want to take a look is who are the more vulnerable to a drop in the demand. As you can imagine, when the prices go higher, the demand will come off, right? So there's a natural reaction. So here we look at Southeast Asia, which are the countries that are more vulnerable to drop in foreign demand. In this case here, my colleague Jester has put together this chart and look at the demand from China, EU, and US. So here the US is the one that is that will be the main driving factor in terms of hitting in the drop in the demand, right? Because US is the one that will be imposing tariffs of their imports into their country, right? So here in this case here, Singapore and Vietnam will be more vulnerable to drop in demand from the US, right? Particularly if you look at the blue color. So the way to look at this is if you look at the total height of the bar, right? These three countries, the higher the bar, the more vulnerable to external demand declines, right? So specifically from the US is the blue bar. So the higher it is, the more vulnerable to shocks to demand. Here in this case here, the large tariff rates are going to have some impact on this demand. Now, the lower the bar, in the green color here is okay, less vulnerable, right? Less vulnerable with the Philippines and Indonesia. And then Malaysia is somewhere in the middle. Malaysia and Thailand, not as high as the red color boxes, but are still to some extent being affected by this drop in foreign demand. All right, and the last thing is look at the trade dependence. So very similar to the slide before that. Look at the more open your economy is, the more trade that you do, the more vulnerable you are to trade so-called trade shocks, right? So that is, I think Singapore is of course number one, although we are only subjected to 10%, but our neighbors, right, in Asia are subjected to much higher rates. So that will be impact on Singapore's position as a trade hub, like what today Prime Minister Wong mentioned in Parliament, right? So we are moving into uncharted territory. The international trade system and order and globalization, I think, may not be the same as what we used to have. So that is going to be very disruptive if the tariff rates are going ahead. Right. So the next one, more vulnerable, is Vietnam, and similarly, I think the Malaysia, Thailand is in the middle, and then Philippines, Indonesia at the bottom. Now for China itself, take a look, it's about only 20%. So from if you look at from paper, that may not be so much disruptive, relatively speaking, compared to, let's say, Vietnam, right? And China's size is much bigger. But again, I just want to caution that it is not to say that China is so-called safe, right, to these tariff rates. After all, this is a globalized supply chain, right? It's a globalized supply chain system. So any part of it having issues is going to feed back to the entire chain. Here, if you look at the end of the pipe, right? The end of the pipe is a consumer demand. If there's a shock, it's going to send a shock wave through the rest of the supply chain, and including China, although China itself is large enough to absorb some of these shocks. All right, so as a result of all those factors I mentioned, we have already made one round of growth downgrades to Southeast, some of the countries that we monitor. For example, those with a sign, a caret sign, for example, here a caret sign on Malaysia, we already downgraded this year growth projection for Malaysia to 4%, for example, from about 4.8% as a result of the, last week's announcement and all that. And then Thailand is another one. We downgraded from 2.7%, if I remember correctly, to 2%, right? So all round downgrade, and Vietnam as well from 7%, we downgrade to 6% growth. And I think more to come because I think next week, and my colleague Jester just downgraded this morning for Singapore itself from 2.5 things to 1.5, so 1 percentage point downgrade. So that is, I think, I think there is just our preliminary assessment. And for China itself, I think is subject to also, I think, to downgrade, but maybe the magnitude is lesser. But it's still early days. We're still watching how that is going to affect, I think, the economy as a whole. And US, Alvin already mentioned earlier that we already revised downwards US growth to 1% from 1.8%, and the probability of recession in the US, I think is going to be around 40% probability, right? So in summary, looking through just now what I shared with you, basically what we have here is that the tariff, as Alvin mentioned, is surprisingly large magnitude, and also in terms of the coverage, right? About 180 countries, being really everyone gets something get some love from the US basically, in at least 10%, right? Even those are islands with no inhabitants and only penguins also get love from the US. So in maybe the Liberation Day looks more like an obliteration day, especially if you look at it from the financial markets point of view. But the thing is that I think those are factors that I mentioned just now. Those countries with high degree of openness and tariff rates being applied, exposures and dependence to the US, and also product concentration, I think will be more vulnerable to the tariff shocks. So we are still monitoring the situation. I'm not surprised that if we were to do another round of downgrades, right? And this is what happens as we assess the situation. Now, as to look ahead, actually, is quite grim. The days ahead are quite grim. I think more tariff pains may come because of retaliation. Right? China this morning already responded to the threat of 50% more on the country and say that they will just continue to fight with continue to fight with the US. Right? So, and maybe there are more products to be included as well. Semiconductors and pharmaceuticals have not been included in last week's announcement in future, potentially. So I think we have to think about the possibility of a recession as well, not just in the US, but this part of the world. Now, I think the last point here is that, again, I think this is a clear reminder of risk management, whether you're talking about company or even personal, right, or countries. I think diversification is still the key here, particularly to non-US markets, right? I think PM Wong today also in his speech, in his parliamentary statement, also mentioned about this, exploring opportunities in non-US markets, and also, of course, a hedging of financial market exposure is very important, and that is, I think, in terms of exchange rate volatility or interest rate volatility or other things. So that's an important element that we always, I think, have to keep in mind here. All right, with that, I will pass the time to Peter, my colleague, for FX and dollar outlook. Peter, over to you.
Thank you, Teck Hin, and thanks everyone for dialing in. So in the coming section, I'll share a little bit about what do we think about the FX market. So essentially, I think while most attention is on the equity market, the FX market also has its fair share of volatility in the last couple of days. So over here, you see that both the Asian FX and also the G10 FX has a big increase in terms of the implied volatility. And I think just based on 2 days, it's quite meaningful already. Just to give you some examples, so in the G10 FX, we had the Australian dollar falling across Friday and Monday by over 5%. This is the biggest 2-day loss since 2020. That was during the height of the COVID crisis. And in Asia space, we have the Indonesian rupiah and the Vietnam dong. These are the two economies that are hit pretty hard by the tariff. And they have each fallen to record lows against the US dollar. So just to give you some context about the volatility. And I think the bad news is this volatility will continue to persist in the FX market because we all know that this is just the start of the second trade war. And I think it is more likely going to be more pain in the short term before parties will eventually negotiate some deals along the way. So short term, I think as uncertainty rises over the tariff, likewise, FX volatility will stay high. So let's get our dollar view up front very clearly. So you have seen in the last, since the start of the year, the dollar has been dropping. And the main reason behind that is because the market is pricing in more rate cuts, especially so after what has happened in March and April, where tariff risk has risen substantially. So as growth risks emerge, markets is now pricing in from one rate cut this year to at the start of the year to right now, I think 4 rate cuts that's being priced in by the Fed. So more rate cuts typically translate to a weaker dollar. So that's the reason why the Fed, or the dollar has stayed soft in the last couple of months, and we still expect this dynamic to persist. So growth concerns will continue to increase or rather recession risk is continue to escalate as long as the tariff war is still ongoing. And because of that, the dollar is expected to stay even weaker. So this essentially sums up our expectation of where the dollar index will go in the coming quarters. So currently, say at about 102, we are looking for it to drop gradually towards about 99.6 by the end of the year. And by the first quarter next year, about 98.6. So like what I shared earlier, this is due to the fact that the Fed is cutting rates and the interest rate differential between the Fed and the rest of the G10 central banks is narrowing. So the advantage for the US dollar is also dwindling, casting a downside pressure on the dollar index. But is it all going to be a smooth traffic from here? The answer is no. And why is that so? It's because there is still the lingering inflation spillover that I think even policymakers are still trying to quantify at this point in time. As you know, tariff is inflationary. And when there's inflation, the Fed may not be able to make such a straightforward decision to cut rates. So they may pause a bit longer than expected. And because of that, because right now the market is pricing in so many rate cuts. So if the Fed stays cautious or stays patient, what this translates to is that maybe the dollar may also fluctuate on the upside too. So these are the risks to the upside currently that we potentially see, where if there's more tariff means more inflation, the Fed can't afford to cut, or they have to wait to be a bit longer before cutting. So that could cause the dollar to be a bit sticky and to inject also volatility on both sides going forward. So this is just to be reiterating the first point which I mentioned, which is currency markets will stay volatile in the near term. So moving to the different currencies, in our base case where we expect the dollar to weaken. So which are the winners against the dollar and which are possibly the laggards against the dollar? So I'll start off with the winners. Euro is turning, I think the market is turning fairly bullish on Euro because of quite a fair bit of long structural events that's happened. In the month of March, Germany has passed a 500 billion spending bills to buffer up their defense and also to also improve their infrastructure. So that is meaningful because over the long term, this kind of fiscal stimulus is important to support the currency. And indeed, in the month of March, the euro has responded, rallying very strongly from about 105 to currently about 109, so thereabouts. So we see this as a meaningful turnabout. And as you can see over the bottom part of the chart, the market is also turning net long on the euro for the first time in many, many months. So I think going forward, euro is going to be promising. Look to accumulate euro on the dip to make use of this expected weakness of the dollar. Likewise, sterling pound rising from a fairly low level in terms of in the last couple of decades. This chart is the price performance of sterling against a basket of currency, trade-weighted basket, and also sterling against the US. As you can see, even with the recent rally, sterling is still relatively attractive on valuations over the longer term. And I think if you notice, UK is also, I would say, one of the current economy that is, I would say, escaped the wrath of this reciprocal tariff. They are only prescribed a 10% reciprocal tariff, and compare that to European Union where it's 20 to 30%, and if you add the steel tariff, that's going to be a lot more. So I think UK, in terms of tariff-induced uncertainty, will be a lot lesser. And so as a result, I think the sterling pound may be one of the outperformer within the G10 space going forward. Yen is likely, we still continue to favor the yen because what is clear in the last 1 month is when there is uncertainty about in the financial markets, I think the demand for yen as a safe haven will increase. And typically, how do we measure uncertainty? We proxy it by the financial markets, the VIX, which is a measure of equity market volatility. So as you've seen back in 2024, just a year ago, when equity market volatility is highest, that's when the dollar yen dive the steepest. So likewise, I think right now the volatility is highest because of a lot of uncertainty about this trade war. So likewise, and in the near term, safe haven demand could cause the dollar yen to be very volatile on the downside. And also at the same time, let's not forget the fundamental reason why we favor yen in the first place, which is because the Bank of Japan is hiking rates, the Fed is cutting rates. Also on the interest rate gap per se, yen is also gaining. So both reasons are suggesting lower dollar yen. So be sure to hedge the downside for dollar yen in the coming weeks or months, whenever possible. So we talk about the winners against the dollar. So what is other currencies that may not gain so much against the dollar, even with the expected winners in the US dollar? So I would like to say the Aussie is probably one of the laggards within the G10 space going forward. And the reason is because the Australian dollar is fairly correlated to the RMB or the renminbi, the CNY. So essentially, when we have a trade war where the tariff against China is escalating, a lot of China-related uncertainty, this will also cause a big drag on Aussie. So while we expect the dollar to weaken, Aussie may also not rise so much against the US dollar. So this, and I think like what I mentioned a bit earlier, there's definitely a reason why Aussie dropped by the most since pandemic over the 2-day period. In the last 2 days, why is that so? It's because Aussie is definitely a risk aversion currency, or rather when risk is not doing well, Aussie will fall. So for this currency pair, I will be a little bit more cautious to play the upside. Moving to Asian currencies, I think everyone is looking at CNY because despite all the uncertainty so far, it's worth mentioning that the CNY has only depreciated about slightly under 1% against the US dollar in the past 1 week or so, which is phenomenal, I would say, because I mean undercurrent is so much, but this doesn't mean that everything is going to be hunky-dory for the CNY. In fact, with 50%, 54% tariff or whatnot, and Trump threatening another 50% by tomorrow, I think the downside risk for CNY is going to be a lot. So that is the reason why last week when we published our latest FX forecast, we decided to downgrade CNY forecast even further. So we are looking at about closer to about 770 or 780 against the US dollar going forward. So this is definitely definitely we have to be cautious about CNY going forward because it's just way too calm. And if you've seen how the first trade war play out, it's a matter of time where this will break out on the upside. And I suspect that maybe in the next couple of days, if we ever touch above 735 on the spot dollar CNY, I think losses on the CNY could accelerate going forward. So this is a level, I think we are very close to that level this morning. So we just need another day of fixing where the PBOC fix it a bit weaker, then that could propel a move above 735. So do watch out for the CNY exposure. It is still not too late to hedge for a higher dollar CNY. In terms of dollar Sing, I think we are lucky in a way where Singapore's tariff is, at least on a headline basis, is 10%. But like what Tekin has alluded to, the second order effects on Singapore economy because of the very open economy. I mean, there could be more to just tariff alone, because slowdown in global trade definitely hits Singapore economy, and we just downgraded Singapore economy. So currency may not do too well. But I would like to highlight that the dollar Sing actually move a lot more, or take a lot more guidance more from the monetary policy stance of MAS, which is at the current juncture is still a positive appreciation slope. Next week we will have the next policy meeting. I mean, chances are good that we will lower the slope potentially to even zero. But I think even so, we've seen before during the first trade war, where having a zero slope, the Sing dollars may stay stable, like what we've seen before, like what I circled out in the first trade war, where it's more sideways. So in the near term, I think we could see the dollar Sing go a bit higher, but in our base case, we are capping it at about 139 at this point in time. So this is consistent with dollar CNY at about 770, 780 thereabouts on a high. So, but nonetheless, the direction wise is for still dollar Sing to go higher in the next 2 quarters. And why is that the Asian currencies are not doing well right now is because there is just simply way too much portfolio outflow. I think rightfully the market is concerned about the prospect of growth in this region, especially where hit with so much tariff. And in fact, in the last quarter, in the first quarter of this year, we had Asian equity outflows that's comparable to during COVID. So if you can see over here, Trump 2.0 in the first quarter, the drawdown or the outflows in Asian equity market is just as much as COVID. So just there's a reason why the currency is weakening. The final slide I have for you is on Asian currencies. And clearly in the last 1 week since Liberation Day, 2 currencies stands out as the biggest losers so far. And they are the Indonesian rupiah and also the Thai baht, which is dropping about just over 1% in the span of 1 week. And there is a commonality about both currencies. They are one of the highest. They are economies which one of the highest reciprocal tariff. So definitely, the higher the reciprocal tariff, the higher the pressure on the currency, and we are seeing that being played out right now. So if you have exposures in the Thai baht or rupiah, I think be a little bit more careful because the way on the currencies or the economy is a lot more on a relative basis compared to other economies in the region. So that's it for me. I pass on the time to Khun Hao. Thank you.
Thank you, Pete. Okay, so before we head into the Q&A segment, just give me a few minutes to run through with everybody our latest commodities outlook and precisely on the 3 key commodities that everybody's worried about, which is gold, LME copper, and Brent crude oil. And you notice that in such a situation where, markets are very volatile and the growth outlook can be very, very divergent, you get very, very interesting insights and price actions from the different commodities. Gold, our view is very, very clear. We stay positive on gold and we keep to our $3,200 forecast by the first quarter of 26. Now, you notice that despite the volatility since late last week, gold has fallen by only, about barely just $200, $150, and it's now recovered the $3,000 per ounce handle, and it has exhibited some of the least volatility amongst the different asset classes. And I think we all know why, because amidst this growing uncertainty in geopolitics between US and China, this uncertainty in trade between US and China, this increasing conflict, the need for safe haven hedging continues, and this is especially so for gold. So in fact, the latest numbers that were out just last week from the PBOC confirmed that despite the recent strength in gold prices, the Chinese central bank continues to buy into gold, continue to allocate more into gold. You can see from this chart, gold now takes up about 6% of PBOC's balance sheet, and we can expect more of that to follow. Now, unfortunately, for the rest of the industrial metal space, whether it's copper, whether it's aluminum, or so I said, whether it's nickel, so on and so forth, you notice there's been a setback in industrial commodities prices, particularly metals, especially after the tariffs were announced. The reciprocal tariffs were implemented on Liberation Day. And this is simply because now markets are forward-looking. Markets are looking ahead and starting to worry, like you and I, all investors, worry about recession next, whether it's in the US, whether it's in our region, so on and so forth. And this means lesser demand for industrial metals, and particularly, Dr. Copper, which is seen as a very important proxy for, the global economy. So you find that copper prices, whether it's on LME, whether it's on COMEX, has collapsed back in just a few days, given up all of its gains since the start of the year, back to where it was, late last year, before all these worries about tariffs started to set in. So in fact, we have a slightly negative view on industrial metals and copper in particular, and we maintain that because going forward, clearly the growth outlook across all different geographies will be very, very challenged. And to put it very bluntly, investors get hot gold because whole gold is a central bank asset, right? Gold is basically an investment asset. But it's a very different thing to hot copper eventually because you need to consume copper. You need to use copper for manufacturing. So if growth slows down, clearly copper prices will take a hit. Finally, a quick word on crude oil. Those of you who have been following our reports will notice that this morning we have downgraded Brent crude oil outlook further, dropped our forecast by a further $5 per barrel to about $65 in the next 2 quarters and $60 in the final part of the year and early 2026. The reason is very simple. Because of all this tariff uncertainty and all this downgrading of growth, we expect weaker energy demand going forward. Unfortunately, at the same time, those of you who have been following OPEC will notice that OPEC last week basically returned back quite a fair bit of the production that has been put on the sidelines, and much to the surprise of many of us who were watching OPEC. So this combination isn't really good. There's a lot of conspiracy theory that OPEC is now helping President Trump to try to push oil prices lower. Now, we will never know whether this is the case or not. OPEC, of course, denies that it is trying to push oil prices lower, but this is the net effect of it. You find that Brent crude oil has collapsed below $70 per barrel, now about $64, $65 per barrel. We believe the risk is that oil prices will hit further lower down towards the $60 per barrel handle. So in other words, gold is still a win, whereas copper and crude oil, we will be much more careful and we will expect more price weakness from here on. So that's our quick rundown for commodities. With that, let us head straight into the Q&A. And can I invite Tekin, Alvin, and Peter to join me back into the Q&A room? Okay, so we have quite a few questions in the chat box right now that's going on. In fact, I'll just start picking them off in order of where they come through. I think, needless to say, there's some concerns about what to expect next for the US economy, particularly the Federal Reserve. So, Alvin, the first few questions will go to you. Now, Alvin, if I hear you correctly, you forecast now a 40% chance of a recession in the US, right? You have dropped US GDP from 1.8% to 1%, and yet at the same time, you raise US inflation forecast from 2.5% towards 4% for CPI. So the first question that we have in the Q&A box is basically, I think, one that a lot of customers will ask. Between the slower growth and the higher inflation, how is the Fed going to decide how are they going to cut? I mean, we see 3 cuts going forward, but your forecast also see higher inflation. Is that going to make it very difficult for the Fed to cut going forward? Alvin?
Yes. Hi. Thanks for the question. So this is I think it's a very valid question because the inflation does look well above the 2% objective. You look at where the number we have forecast, and I think in the markets itself, some of them are even higher. But the fact is that if you look at this inflation spike itself, right, the Fed could justify it based on the fact that this could be a supply shock and not induced by demand. It is a bit like thinking the tariff is after all a tax. And you think of it like GST. If it comes in, right, it comes in one time, right, next year, right, it will be washed out from system. The inflation number will no longer be there. Of course, the danger itself, right, if this is a transitory, then that's where the Fed's justification for the cuts can come in. However, if they have a de-anchoring effect of longer term expectations, then that will put the Fed in a bind because it will be the fact that growth is slowing down tremendously, but yet they are seeing inflation higher and expectations are also for inflation to go higher. That would be where the bind is. But as I explained, if we look at it as transitory itself and next year itself, when demand remains weak, right, and the growth portion becomes, of course, the growth portion is the one that's significant part. Therefore, we think that that will be able to justify for the Fed itself to cut rates.
Okay, so in other words, the key consideration front and center is the growth slowdown risk, which
And
we believe the Fed will act on. So that's why our forecast is 3 cuts this year.
yes, and
But
it's also the assumption that a transitory effect of the tariffs on prices.
okay, but of course, as you say, you know, the assumption is that the inflation risk is transitory on prices, but we need to watch that space very, very closely, right?
Correct. Yes, definitely.
Okay. Next question to you as well, Alvin, and I think you get that a lot. I think all of us keep comparing this to COVID, right? In terms of the magnitude of the self and asset prices and the urgency and the damage to the global economy. What's the odds of emergency Fed rate cuts in the next few days or weeks?
Okay, if on the personal level, I think that would be still a low risk. If you think of it, of course, COVID was it's a pandemic, and it's the outcome was this in itself is lack of a better word, a man-made disaster from the Trump administration. Of course, when it is a man-made, there is good chances of there some reversal negotiations to take place. But the part is right now we are in the initial phase. But I think as we heard from Powell's speech last Friday, right, they see it as huge uncertainty and therefore they want to wait and see. They have not shown that they want to put what they call a Fed put there. And I think that is perhaps the right way of assuming this because they have been through an episode. Of course, right now, the tariffs versus the first administration is much more punitive, but also bears watching for them that they do not react in a manner that may be may be detrimental, especially if it does reignite, for example, inflationary forces.
Okay, so if I can prick everybody's bubbles, I think the odds, Alvin's message is the odds of an emergency Fed rate cut at this juncture is still very low, and again we got to see the messaging from Chair Powell very closely going forward. So thank you, Alvin. Taking quite a few questions on ASEAN here. We hear in your presentation you have used the word dire quite a few times, right? I think that got quite a few clients worried. Broadly speaking, when I passed through all the macro reports written by all our macro analysts over the past few days, broadly speaking, in terms of the growth downgrade to GDP for all our regional economies, right, from Malaysia to Singapore to Thailand to Vietnam, they're down by about 0.5 to 1% in terms of the growth downgrade that the team has made. So if I can ask you very directly, what's the chance? There's a few questions on so-called crisis in ASEAN. I'll just lump them together. What's the chance of an ASEAN or Asia financial crisis going forward, given what has happened?
Well, this kind, if you were to compare to the Asian financial crisis that we had before, I think today conditions are different. I think today conditions are actually much better compared to those Asian financial crisis days, right? Our reserves are much stronger. Actually, our exports have been booming, and the infrastructure in terms of the supply chains and all that is actually quite well oiled, well run, right? So I think this kind of comparison to Asian financial crisis may not be suitable. But however, because our export-oriented nature, in those slides that I show, I think we are vulnerable to shocks to demand. As a result, I think business activities themselves, right, could slow down if there are demand shocks filtering through, particularly from the US. And that could cause a bit more on a recessionary kind of situation rather than a crisis type of situation.
Okay, and just to build on that, clearly, as you say, there's a lot of changes when it comes to trade, supply chain for the region going forward. We have one question that is very interesting that I think a lot of customers are starting to ask about, which is about the deflationary risk of potentially Chinese goods coming in to flood our region. And I think this premise is a very important and yet very simple outlook. For example, clearly, if the tariffs are imposed and Chinese goods can't make it into the US, they will have to be rerouted elsewhere, this overcapacity, this volume elsewhere in the world, whether it's Europe, whether it's ASEAN, right? So in recent days, there's this concern that this Chinese overcapacity and trade volume, unfortunately, over the near term, will have to be rerouted through ASEAN and Asia as well, creating the risk of a deflationary spiral for our region. What do you think is this risk? Is this a real risk, or do you think this can be mitigated by the region?
All right. I think for this so-called deflationary risk, I don't want to unfairly pin it on China, because China, of course, is one place where final products are manufactured or assembled and then sent to the rest of the world. But if you look at the supply chain, the supply chain, and also those slides that I show, these countries, for example, Vietnam, Indonesia, even Indonesia, Malaysia, Thailand, they do send stuff overseas to the US. So the tariff will have a direct impact, right? The tariff will have direct impact on all these countries, including China. So, and some of these demand coming off from the US would have to be filled somewhere, right? Would have to be filled somewhere. And therefore, that's where the deflationary risk that you talk about, I think, is pretty real. That means prices will be under pressure. After all, capacity utilization will come off when the demand comes down throughout the world, not just in China, not just in Southeast Asia. We're talking about Europe, India, and other places as well. Yes, there's a risk of deflation pressures on if the tariff rates go through.
So I guess the whole world is in this together in terms of the risk. And this is why, ASEAN is trying to work towards a common message and a common response in terms of how to mitigate this tariff risk with the United States. Thank you, Teck Kin. Moving on to Peter, many questions on FX. If I may just pick a few first, those few clearly will be all about Vietnamese dong, right? This, I think, has got a lot of our customers' worries, given that Vietnam is facing one of the highest tariffs across the region. So can you please elaborate a bit more about your Vietnamese dong outlook? How bad will it get for the dong?
Yeah, so there's a few things to look at it. First is on a headline basis, definitely Vietnam is only second to China in terms of tariff rate. They have a 46% reciprocal tariff, and it's also gradually showing up on the currencies, which is at this point in time is about 25,960. So this is a new record low against the dollar. I think the path of least resistance is still on for Vietnam dong to weaken further. I think that the magic question is by how much. So as it is right now, we think that we put out down in our forecast to be a low of 27,200. So still quite a fair bit to go. So about 1,200 dong to go. And I think let's balance it up with, I mean, is there really light at the end of the tunnel? And I think from the headlines, it's clear that Vietnam is very eager to negotiate a trade deal with US. And I think if there's any, they're going to be one of the first to do something about that. So that could be something to look forward to. But in the near term, I think inevitably the dong have to depreciate. But if you look at it on a percent, I mean, year to date by percent, I mean, the devaluation is fairly orderly, I would say. I mean, it's only down by just under 2% year to date. Can it get worse? I think yes, but would it get a lot worse? Hard to say at this point in time, but let's hope before it gets a lot worse, I mean, clearer minds prevail and we get something at the end of time.
Okay. A few questions on dollar Sing and of course next week's MAS MPS decision, monetary policy statement. So if we hear correctly from you, your forecast is that dollar Sing or Singapore dollar may well weaken a little bit towards the 139, 138 handle, given the expectation of renminbi weakness, so on and so forth.
Yep.
How does this reconcile also with your comments that MAS next week will likely ease on Singnia as well, and you have said that, you know, worst case MAS may well go fully flat in terms of the appreciation path. How do you reconcile this two?
Yeah, because I think I mean, thankfully for Singapore, our reputation as a regional safe haven is there, and I think even as this trade war intensified in the last couple of days, I think people are still seeking safe harbor in the Sing dollars. So that will cushion, I think, a lot of the pressure against the currency. That's for one. And I think even in the case where the MAS totally flattened the slope, based on our experience in the last trade war, even with a flat slope, the Singnia may even prevail at the top end of the policy band, which is, it goes to show that there is some really some safe haven demand. I mean, regionally, I mean, I see this, I mean, for the layman, I see this as the yen of ASEAN, something like that. Yeah, so this could be playing out again. But of course, we always say that this time it could be a bit different. And I mean, Prime Minister Wong has already alluded that let's brace for impact. It's not really so rosy. So maybe currency may take a little bit more volatility. But at this point in time, we assess that the top may be 139.
Okay. So building on that, there's this concern we hear from you that perhaps, you know, as what Alvin says, the Fed's going to cut 3 times.
Yep.
That will weigh on the broader dollar. And yet, on the other hand, you also mentioned very clearly that renminbi may fall to 780 if things don't go right in terms of the tariffs.
Yep.
So between these two, how will the Singapore dollar react in the next few months if these two extremes do materialize?
Yeah. So whenever, well, I mean, it is. I mean, the RMB sets the trend for the region. So if the RMB is certainly going to depreciate, or the dollar CNY is certainly going to go higher, there is bound to be upside pressure for all different currency across the Asian spectrum. So we are not denying it. We are just saying that the upside pressure for dollar Sing may be a bit lesser relatively compared to the rest of the region. But it's still meaningful because 135 right now to 139 is still 4 big figures. So it's still about 2 to 3%. So it's still worth to really look at hedging this exposure, because if you're wrong about it, I mean, it could get a lot worse. I mean, we can trade above 140. But I mean, from here, 135, I see a lot lesser risk or lesser probability that we are wrong about this call, about going higher and going lower. I think that is something I think we are not entertaining at this point in time.
Okay. So there are many other questions on FX, if I would say, you know, we practically have one question on each currency here, one on ringgit, one on rupiah, one on Aussie, so on and so forth. Those of you, if you can we just request that you identify yourself in private to your relationship managers? We'll take note of these questions and we will then return to you with specific answers to your questions about the different currencies. In the interest of time, unfortunately, we will not be able to answer each of them here. We are now at the hour. Before we close this webinar, I think I want to shift the tone towards the end to a positive one. So can I ask each of the panelists, right? We have discussed about practically everything in shades of black, right? Growth downgrade, currency depreciation, region contagion, Fed emergency rate cut. If there's one positive silver lining you would like all our listeners, all our customers to take away after this very chaotic week after Liberation Day, what would be the key positive takeaway? Maybe Alvin, start with you first. What's a positive takeaway?
Positive takeaway. I will quote PM Wong, do not fear.
Okay, and what doesn't, how should I say, what doesn't kill us makes us stronger, right?
Yeah, what doesn't scare you to death makes you wake up the next day.
Okay, Teck Kin, positive takeaway?
All right, for me, the positive takeaway is I think I also invoke PM Wong today that this US market is important, but there are other non-US markets that we should look to explore opportunities, right? So right now there's a lot of restrictions here and there, but there are non-US markets, and also work with like-minded partners to help you along the way. For example, UOB, you know, to explore the regional markets and also other markets where UOB has the network to support you in the journey.
Okay, so diversify your supply chain, build your trade network, right? There's never a better time. Thank you, Teck Kin. Peter, lastly to you, positive takeaway?
Yeah, I'll say that I get this every year, and I think just to remind, I think every year we get something about that will propel us to think about the broader de-dollarization trend. And I think certainly when businesses want to avoid the volatility or to be subject to US dollar policy uncertainty, then I think it's really time to think about settlement in non-US dollar. I think, and across the block, we have a lot of initiative. I think in the coming weeks, days, or even months, I think this will gain traction as I think people look for alternative to the dollar and whatnot. So this could be something for your longer term plan. I see this as a very positive development as an alternative to the US dollar. Yeah.
Okay, Pete. So thank you, ladies and gentlemen. Thank you, Teck Kin, Alvin, and Peter. Again, I think there's a lot of questions, and I don't think we are able to answer all of your questions and settle all your worries in the past 1 hour. The research team is working hard to update everybody on a timely basis in terms of the latest development, whether if it's growth outlook, central bank policy view, FX or rates forecast. Do continue to stay tuned, continue to follow our reports very, very closely. If you do have any questions, please do sound them out to your relationship managers and GM sales partners, and we will be doing together to help all of you navigate this very, very difficult and volatile period. So we have come to the end of the webinar. Thank you, everybody, ladies and gentlemen, for your kind attention. There's a little feedback segment now towards the end. If everybody can just take a little bit of your time to answer the feedback so that we can, improve on our webinars going forward. Thank you, everybody. Stay strong and remember, diversify your risk. Thank you.